Welcome to the Pirls Stock Market Commentary video, your weekly window on stock market technical conditions, featuring the proprietary bull bear point and figure market breadth summary chart for October 28, 2018. Market breadth. With this past week's market decline, our bull bear point and figure ratio at 0.21 fell from 0.30 last week. The total count of securities in bullish or bearish patterns increased 7% to 3,324. The count of bearish stocks increased 15%, while the count of stocks in bullish patterns decreased 19%. The Pirls PNF market breadth summary chart shows us a market now 8 weeks in bearish territory. Paid subscribers have access to the Open Office Calc data from which the chart is generated. You may become a paid subscriber by visiting s2pmarketsignal.com, clicking Membership, clicking Register, and following the prompts. To receive the weekly Pirls Stock Market Commentary via email, free of charge, simply enter your name and your email address in the spaces provided and click Subscribe. The well-known market breadth indicator, the Nasdaq McClellan Summation Index, fell 257 points, for the 16th decline in 20 weeks. At a negative 959.74 points, it continues below all 8 tops above plus 100 in the last 30 months, and it continues below all 4 bottoms below minus 100 in the last 30 months. Volume analysis. In this week's volume analysis, the Nasdaq Composite Index ended in distribution mode, with average daily volume higher than the prior week. In the last 2 weeks, the Nasdaq had 1 accumulation day and 4 distribution days. Accumulation days are counted when the index closes up on higher volume than the prior market day, while distribution days occur when the index closes down on volume higher than the prior market day. Last week, the Nasdaq ended in neither accumulation nor distribution mode on lower average daily volume. Momentum. The CCI 20 daily, now at a negative 128.84, fell from a negative 85.81 last week. The CCI 20 daily, in a Woody's downtrend, has not yet risen to the plus or minus 50 range required for a valid zero-line reject short entry signal. In Woody's CCI trading system, 6 consecutive bars above or below zero are required for a change of trend. The weekly CCI 20 of the Nasdaq Composite Index began a Woody's uptrend 129 weeks ago, while the daily CCI 20 began a Woody's downtrend 2 weeks ago. The CCI 20 weekly fell to a negative 220.95 from a negative 140.42 last week, continuing below the plus or minus 50 range required for a valid zero-line reject long entry signal. Industry rotation the last 2 weeks. 2 of the top 5 industries are positive, and all of the bottom 5 are negative. Summary REITs on the top, oil, oil services, gold and silver, and some tech on the bottom. Bullish REITs continues in the top 5. Oil and oil services continue in the bottom 5. Gold and silver has left the top 5 and entered the bottom 5. KBW Bank has left the bottom 5. Bearish disk drives has re-entered the bottom 5. Focus this week from www.peakprosperity.com. Is the long-anticipated crash now upon us? By Chris Martenson. The following are some key points and charts. I predict a major crash collapse across stocks, bonds, and real estate is on the way. The recent market weakness seen over the past 2 weeks is nothing compared to what's in store. As we've been carefully chronicling, bubbles burst from the outside in, starting at the weaker places at the periphery before progressing to the center. Emerging market equities are now down negative 26% from their January highs and negative 18% year to date. China's stock market is down 32%, even with substantial intervention by the government to prop things up. The periphery has been weakening all year, and the contagion has now spread worldwide. Taken as a whole, global equities have shed some $13 trillion of market capitalization for a 15% decline. The rout has spread to the core with surprising speed. Now even the formerly bulletproof U.S. equity markets are stumbling. The S&P 500 is now negative on the year. It's been obvious for a long time to those who have watched the crash course that endless growth is simply not possible. Not for a bacteria colony in a petri dish, not for an economy, not for any species on the planet. Eventually, when finite resources are involved, limits matter. But the vast majority of society pretends as if this isn't true. My perma-bearishness is a byproduct of peering into the future and not being able to align society's hopes with what I see as the current trajectory of the world. Is parking money in a 401k in a general index fund, crossing one's fingers and hoping that the next 20 years will behave like the last 20, a good bet? Not if sustained economic growth continues to remain elusive, the way it has since the 2008 crisis. A critical factor is that our system for running the world is becoming increasingly unstable. As surplus energy decreases, we are using more and more debt to pull tomorrow's prosperity into today to keep the party going. As 2008 showed us, when the debt stops growing, even briefly, the whole system shudders to a stop. Our current system of credit money is either expanding or threatening to collapse. It no longer has a middle ground. We are now at the most important inflection point in all of human history, yet practically nobody knows about it. But try to raise people's awareness and, wow, does it ever challenge their belief systems? Fear and anger are the first emotions to get triggered, and listeners quickly search for any reason to reject the information. There are a number of indicators we watch closely here at Peak Prosperity. While many are showing signs of distress, we're not yet seeing the kind of systemic arrest we'd expect to see preceding a market seizure. For instance, even as equities have pulled back, the weakest credit element, here represented by the ETF JNK that tracks junk bonds, has barely even budged during the current sell-off. What tipped me off as a pre-indicator of the 2008 crash was the movement in both the credit markets and the financial companies most dependent on them. Remember, quote, stocks are for show, but bonds are for dough, end quotes. The serious money playing in the bond market typically seeks safety before the more risk-loving players in the equity markets catch on. Similarly, the prices for safe haven U.S. Treasury hasn't rallied by all that much. If there were a panic brewing, we'd expect to see these spiking more violently, even with China beginning to sell their stash and the Fed pulling back. The last bounce doesn't even bring U.S. 20-year bonds back to even for the month of October, let alone return them to where they were in September. Similarly, gold hasn't rallied that much either in U.S. dollar terms. In euros and yuan is another matter. Add to the above that the U.S. economy is not yet in recession, and a full-blown crash looks unlikely to unfold before us right now. But what we are seeing in the markets is exactly the kind of precursor activity we would expect to see in the final stage, leading up to a crash. Thank you for watching this week's Santu Pirls Stock Market Commentary, featuring the proprietary Bull Bear Point and Figure Market Breadth Summary Chart, compiled by Donald Pearl, www.s2pmarketsignal.com. For Santu Pirls Stock Market Commentary, I'm Cynthia Pearl, hoping that you have been enjoying a peaceful and pleasant weekend, that you are looking forward to a prosperous and productive week coming up, and wishing you true success.